All right, welcome to OK Computer. Did you see what I just did there? That's Deirdre Bosa. She is the anchor host of Tech Check at CNBC. Dee, welcome back.
Thank you. Always a pleasure to be here.
All right, did that OK Computer, did it send you a little bit for a loop? Because you have been a generous contributor to this podcast for many years now. And, you know, we had OK Computer. We wrapped it into Risk Reversal Podcast going into 2025. But it's back, baby, by demand, which is pretty cool.
I've always wanted to ask you, is this a Radiohead reference?
Correct. Okay. I think going back to, I want to say we launched it in early 2022, and the idea was, at the time, metaverse was a thing, and there was a whole host of kind of Web3 things. And so my view was that we have this like really complicated relationship with new technology in particular, and a lot of folks were kind of like, what the hell's the metaverse? What the hell's Web3? And so OK Computer, which is a 1997 album by Radiohead, one of my favorite bands, and it's OK. So we decided to call it as OKAY, and in the logo you see it's like exasperated. It's like you know what I mean? It's one of those things. It's kind of frustration. So that's where it came from. But there's like songs like called Paranoid Android on that album and stuff like that. So that's where it came from. Kara Swisher, the first time she was on the podcast, she asked me the same question you just did, and she goes, "Yeah, I think it's a stupid name." So which only emboldened me. Okay, by the way,
you know, I have to take the other side here. I love the name. I forgot too that there's a song called Paranoid Android. How much more perfect could you get?
Yeah, a great.
Yeah, I guess there was no Pearl Jam album available. I know.
You know what? In 1997, Pearl Jam Yield came out. You know, there was Binaural. Binaural. There was a whole host of other things going on there. But yeah, we settled with the OK Computer by Radiohead, but it's really a play on that. So I'm really excited to kind of tee that back up. We heard from a lot of old listeners. We heard from contributors or folks that came on. We heard from a whole host of people. So really excited just to brand that way again. So we're doing that, and we're going to have lots of great folks. You're hopefully going to join me each week, and we're going to do something that you're focused on. You are working on a lot of your own video. You're going to be doing some specific columns of stuff that really interests you. So I'm really excited to be back here doing this with you. Also today, I know he's a good buddy of yours. Jeff Richards is going to join us after this conversation. He is a VC at Notable Capital. He's also one of those guys, but I know that you feel the same way. He's just got great insights, not just about private markets, but also how they feed through to the public markets. So
one of the best who can actually talk about Wall Street and Silicon Valley. It's amazing how kind of rare that is. No offense to anyone.
No, I mean, it is rare. I think a lot of the folks would say, listen, there's no style shift for me here, but I think what's important about Jeff, he's a former operator. You know, his companies got bought by publicly traded companies. He invests in a lot of companies where he hopes that the exit is becoming public or gets bought by, a bigger sort of.
I like to sum Jeff up by saying he gets it.
Yeah,
that's enough.
And he's also one of the good guys. He's one of like the nicest guys out there. So stick around for that conversation with Jeff Richards. All right, Dee, you and I, CES was going on this week. It's one of those things where, you know, last couple of years, Jensen Huang has done the keynote, and it feels like that's when the event, at least from outward, facing, has kind of topped out a little bit. So he talked a little bit about this sort of physical AI moment, or more like a ChatGPT moment, which is, you kind of mentioned. Let's talk a little bit also about like kind of the dispersion we're starting to see in the AI trade, but like Mag 7 and the performance there. And you brought this up, and someone forwarded this note to me by Michael Semblis, who's like a brilliant strategist over at JP Morgan, and some of the things that he had to say in 2026 about the space. Where do you want to start, Dee?
Well, you brought up CES. Let me just take a moment, because we were talking about this on air, and I thought it was kind of funny. Like, over the last few years, it's sort of been on this downtrend. It was all about like smart refrigerators and laundry machines, and nobody wanted to go. And I think you're exactly right. Jensen Huang has like breathed new life into it. And this year, I have to say, I mean, I'm getting real FOMO. I have to go to Niagara Falls for a hockey tournament, which I know you'll appreciate, and so will our friend Guy. But if I didn't, I'd probably be at CES, and I kind of wish I was, because there's some really cool stuff on display. Robots. I mean, I don't know if you saw the Boston Dynamics new robot Atlas is very cool. So I think that, CES is back.
Yeah. I mean, It's one of those things where obviously, these companies, they kind of get everything really dressed up and ready to go because it's one of those events where everybody who's anybody in the tech world, and I mean that globally, they show up to Vegas and they're either presenting or they're either analysts looking for information or investors looking to do things. Obviously a lot of folks in the tech space are just interested in that. So again, pretty interesting stuff from the standpoint of Nvidia and what they have to say. And there was also stuff about, how they're entering the driverless, auto space. And today, we're recording this midday on Tuesday, Tesla's down 4.5%. And, to me, what's interesting about Tesla, is that no one cares about their cars anymore, like their EVs. What they care about are robots and they care about robotaxi. And I think you're likely to see more volatility, in and around those sorts of headlines than you are about missing deliveries in a quarter or a month or something like that.
I mean, right. No one cares about sort of the standard cars, but I do think that the reason, people love Tesla so much is that it's that whole vertical integration argument, right? They have the cars, and so they can just flip a switch is the idea ultimately and turn them all into self-driving cars, full robo-taxis. But yeah, I mean, you could see this a few different ways. CES with Nvidia now moving into the autonomous driving space. I report a lot on Waymo. I hear a lot from the Tesla stands that tell me I don't know what I'm talking about because Tesla's going to just turn that switch and create, millions of robo-taxis. But in a way, it's proof of concept, right? Elon Musk has been working on this and humanoid robots long before they were headlining CES. But on the other side, too, kind of shows the way that like Google's looking at this and Nvidia is looking at this is they're really focusing on the software, the intelligence piece. Maybe it doesn't have to be totally vertically integrated. Maybe that just leads to really, really high costs.
Yeah, and the cost thing is important because do these things scale? I think that's kind of one of the biggest questions, right? And so when you think about Elon and how he looks out into the future, he often, as you know, because I know you report a lot on this, is like he doesn't really hit the deadlines that he sets out and they keep moving the goalposts. But the truth is he kind of always gets there. You know what I mean? Eventually, and it's one of the reasons why the stock has traded the way it has over the last, call it 15 years, or when I think they went public in 2010. And now he has like $1 trillion incentives, $1 trillion in incentives to have all of this play out over a certain period of time with that pay package. So again, one of the things that you just mentioned though about Waymo, and I read this in the FT yesterday, that Baidu very soon is going to be launching their autonomous ride share in London, and Waymo is also going over there. And what I find interesting about that is that for the first time, we can talk about how the Chinese are performing relative to the US in a regulatory environment that looks very different than ours. And I think that's going to be interesting to watch play out over the next year or two.
Right. It's like neutral ground, right? It's not in China. It's not in America. They're both coming from different countries into a space with its own regulations. So I agree. And I think that we're going to be hugely surprised by the Chinese capabilities because we don't spend enough time talking about it. We don't see it, just like we don't see the Chinese EVs. But if you look into the space, if you ever watch a YouTube video, they are so hugely impressive. And we're so used to Tesla with still the safety driver. I think Baidu with its technology is gonna blow sort of onlookers away with its capability.
Well, and the other thing, it's going to be the low cost provider, right? If you think about just the cars that they are going to be deploying their system through, they're just much cheaper than that of, let's say, a $35,000. Yeah.
Well, and actually, Waymo's now looking to use their next generation. I believe is going to use a Chinese auto model, the Zeekr vehicles. So that's interesting. They still have to import them. China just has access to them. So that will be
100%. And then the other thing about the scaling is like, all the LiDAR and the GPS technology that goes on the Waymos right now here in the US, it's expensive. Until you get to some sort of critical mass, it's going to be a really hard thing. I wanted to, and you're out there in the Valley and in SF, and, obviously when you see these, private companies and the way in which they're spending and they're not being valued, obviously on anytime soon about profits, about innovation, it's about, the speed in which they can get products to market and the like. And so I think about Waymo and I'm like, if this was, people who had left Google and DeepMind and they started this company and it was a private company, they would be raising money at like, you tell me, like, you know what I mean? And now internally it's valued at what, $100 billion ish within Google?
Well, that's actually an external valuation because they're taking outside money. Even though Alphabet led its last round, they are bringing in more money from the likes of Tiger Global, and I think Thrive as well. So there's a lot of external money going into it, but I still think you're right. When you look at like Alphabet's valuation compared to Tesla, it's ridiculous. I think I posted that on X like about a month ago. I just got people got so mad at me, but I mean, the numbers are the numbers. Tesla's valued very much for its robotaxi ambitions, and it doesn't even register for an Alphabet. Waymo doesn't register, that is. So yeah, I agree with you. But people are starting to get wise to it.
Really quickly, how are you feeling about X and what goes on there relative to, so you said, you put something out there, you got a lot of feedback one way or another. I haven't been on in a couple of years. Every once in a while, people will send me a tweet, but you pull it up and you really can't see the responses. You can only see that actual tweet. And, Guy and I were just talking about this on a podcast. It's like, he doesn't get how some things get certain, engagement and other things that, just zero. I'm just curious, like, Is it the place that is it similar to what you used to go to for curation, for feedback, crowdsourcing some sort of, I don't know, themes and the like?
The short answer is that I continue to have a love-hate relationship with X. I hate posting because you're just inviting sort of the crowd to weigh in. Yeah. Something that's not controversial can be quickly turned that way. I am always nervous about what's going to be misinterpreted on that platform, but I will say I still do use it. It's still my social network, my app of choice, probably the one that I use most on my phone, because I have my algorithm and I get a lot of really useful information, a lot of takes, and I follow, all the most interesting people in tech and AI, and I think that they're still posting.
Yeah, for me, I used to use it as like an aggregator, really for news and like an RSS feed. And then, obviously following really interesting, smart people was great. But, I don't miss the takes, right? And what I've really gotten good at, I think, on my phone is like I have Wall Street Journal, CNBC, Bloomberg, FT, all the major publications. Information has an app. And I just kind of work my way through them. Was it easier when it was all in one place in one feed? Not really, in hindsight, because there was so much of the bullshit that was wrapped in and around it. You know what I mean? And then the other thing is like, I don't go down rabbit holes. I don't get, like, distracted, that sort of thing. So again, I think that'll be interesting to see that, some of these platforms, you're starting to get a little bit of a pushback, at least from people saying, wait a minute, they really have hacked my brain and I need to get some of that headspace back.
Yeah, I hear that. I would say I'm different. I'm here for the takes. I'm here for both, but I do love the takes. It's all about who you follow, though. And I will say I do have an eye on my algorithm. I try to mute the people who I don't appreciate and click on the people who I do, so I get more of their content. And I'm decently happy with what I'm seeing, but I think it's a shame. I used to use it so much more to communicate with people, and I don't do that as much anymore because I don't understand, what gets surfaced and what doesn't. I posted something the other day, went to the former Westfield Mall in the middle of San Francisco. It was shocking, like a few days before Christmas with a few of my kids, and it was completely empty.
Yeah.
And it was playing this like dystopian Christmas music in the background. This is in the middle of San Francisco. And I thought, I'm going to go to a mall. I know this is on the decline, but there's going to be a few stores that are open. Maybe it won't be that crowded. And it was just shut, this gigantic mall. And I posted a video and it was so funny. It was so political. It went viral. I think more than 3 million views. People were saying, look at what the liberals did to San Francisco. Other people were saying, oh, you must have posted this at 7 a.m. before any of the shops open. So it was a little glimpse into posting just a video. This is just what I'm seeing a few days before Christmas, and everyone jumping onto it to see what they wanted to see from it.
Yeah. Well, it's also the other thing, obviously, you as a journalist, people, don't trust journalists anymore. I mean, they just don't for the most part. And it's a kind of weird thing. And I'm always very quick to say when someone says, well, you're a journalist, I'm like, I'm not a journalist, trust me. And by the way, I have a ton of respect for journalists. And I actually think a lot of that criticism is very unfair. But to your point, I think it's the way in which people are looking at it through what lens, is the point that you just made. All right, pivoting really quickly to the Mag 7 and just the performance last year. One of the things I found interesting is that, if you just look at them, Apple, Microsoft, Amazon, Meta, and Tesla, all underperformed the S&P and the NASDAQ. Obviously, Nvidia had a big year. It was up nearly 40%, but it literally closed where it was trading at some point in August. So it had made no progress one way or another. Now, obviously, some of these stocks had huge gains off of their April lows. Google was one of them, but it also, closed really well. And so I think if you're a tech investor, you're probably happy to see that, because if you think that some of the, early, beneficiaries of, that chat GPT moment in late 22 was Nvidia, then it was the hyperscalers, and then it started making its way into, neo clouds, and then, server makers and the like. But a lot of those trades have stalled, and now you're seeing just so much money. I mean, semis continue to be a space that's just rip roaring, out of the gate here in 2026. But you're looking at storage, you're looking at memory. They've caught these massive, as you and I are talking today, SanDisk is up 24%. Like think about that. So to me, I'm just curious how you think about this. You report on all these names. You have a lot of knowledge about the interconnectivity in the ecosystem. And again, we haven't even gotten to the private markets, but it feels like there's been this rolling sort of like euphoria, and maybe when the air comes out of these names, that you might see a cooling out of the entire trade in the public markets.
I mean, one of the biggest narratives at the moment, and certainly over the last few months, has been this idea of a bubble, right? Could this all come crashing down? And when you sort of look at what the stocks have done over the last year, it hasn't been crazy, right? You said Nvidia did basically nothing for the last 6 months. And so that's probably positive for those that are worried about a bubble. There is some, rationality perhaps in this markets. And we've talked about this before. You look at the valuation of Nvidia, it's not crazy by any means. And also, I mean, I tend to look at this stuff on a longer term basis, right? Last year was 1 year, and US equities as a whole underperformed most of the global benchmarks. But over the last 10 years, the US has been the place to be. And I always think about that because I moved to China in about 2008, 2009, thinking, when the narrative was China's growing faster, the GDP is so much faster and greater, and the opportunity is greater than the US. But over the last 10 years, the US has really been the place to be in terms of economy and equities, and certainly the tech companies. We can talk a little bit about what might change this year, which is something that I'm extremely fascinated by. And that gets to the note that you mentioned earlier called Smothering Heights, right? A great, great read about sort of the risks confronting the AI trade this year, even if sort of the valuations have come down a little.
Yeah, it's interesting when you talk about risks. Last night, Dami and I were at an event where he moderated a panel, and there was, somebody from KKR. There was somebody who was in public markets from Neuberger Berman. The KKR guy was in the credit markets, and then somebody who, was in traditional equities, but now in crypto and runs a company. And, Guy likes to, at some point, ask a question: what are the risks that you see? And generally across, across asset and this and that, whatever risks, like, relative to their own markets. And, to each one of them, nobody, they can throw out a couple risks, but they're not like, oh, I'm not worried about those risks this year. You know what I mean? That sort of thing. So when you read this report, I'm just curious, because Michael Sembelis is considered one of the most widely read, smartest guys on Wall Street, opining on what's going on, as far as tech innovation. I'm just sure, what were your takeaways from that report?
So I like how he framed it at the beginning. He says when markets are at all-time highs, you have to look at the risks. And when markets are sort of low and they have more ground that they could make up, he says you have to think about what can go right. We're at a moment where we have to think about what can go wrong. It's kind of the responsible thing to do. So he laid out 4 medium-term risks, and I thought that they were all really, really smart. I think that a lot of them come back to something that I keep talking about, which is China. So let me lay them out. Do you want me to lay them out?
Yeah, I'd love for you to lay them out.
So the first one he calls a metaverse moment. He talks about, the more than $1 trillion of hyperscaler Capex and R&D since 2022, and how that really needs to translate into durable profits. And if not, valuations are exposed. So we've kind of been seeing that over the last few months anyways, and that's why maybe some of the air has come out of the AI trade. But at the same time, he also talks about how these companies, even though they've got stellar balance sheets, are taking on more debt. He identifies Meta and Oracle as 2 names to watch. And I agree. I mean, we talked a lot about this over the last 3 years. What's going on right now doesn't look anything like the dot-com bubble, or hasn't looked anything like the dot-com bubble, but that could change if the finances get a little riskier or more creative, and companies start to take on more debt and they don't have the earnings to back it up. The second one he talked about is US power constraints, right? You have someone like Sam Altman and OpenAI and Greg Brockman, by the way, putting out videos saying that we can reach, enormous sums of revenue, but we can only do so if we have the compute capacity. That is not a sure bet, right? Data centers, they're running into electricity generation, grid limits that could really slow deployment. And then what happens? There's this whole universe built around OpenAI, which includes Nvidia and Oracle and SoftBank and Microsoft. What happens to them if OpenAI can't reach those targets? The third one you talked about, China builds its own moat. This requires, a longer discussion, but just the idea that we've talked about for the last year, especially ever since DeepSeek, but necessity is the mother of invention. They may not have the advanced chips that we have, but they're finding extremely creative ways to get there, like just clustering thousands and thousands of less performant chips. And they may actually get there like they did with DeepSeek. My next piece I'm working on is sort of that whole hardware bet that China is making, very much supported by the government. The last one that he talks about is the China risk, which is front and center, especially right now, given the geopolitical situation, and just the role that TSMC plays and that it is such a structural vulnerability.
Yeah, one of the things, my quick takeaway from that, OpenAI is at the center of all this, and I keep saying this is like, we're all rooting for you, Sam Altman, because if it doesn't go well, I think there's going to be a lot of pressure. First, I think in the private markets, because if they have a hard time raising capital, and that's the whole thing, you know what I mean, then there's a lot of other companies who are far less important in the ecosystem who are going to start having a hard time. OpenAI will get the benefit of the doubt until the capital markets, do not give them a pass, meaning like until they can't raise equity at higher levels than they raised prior, and they can't, let's say, debt, you know what I mean? And then there is no path to an IPO where you see an up round, that sort of thing. And one of the things I think, with some of these massive names is that a lot of these huge mutual fund complexes or pension funds that used to be that incremental buy or that buyer on an IPO, they're already participating the whole way up, right? And
Right.
So there's no guarantee that the IPO, yes, the companies will sell and they will put cash on their balance sheet, but it may not be at a valuation that validates where all of these investors have participated in the private markets. Okay, so that's one. The other point I would just make about OpenAI is that there's a lot of trepidation all of the sudden about what is their business model, right? As they approach a billion, I don't know if it's monthly actives or whatever the hell it is, but it's still a big number. And then you go back to advertising. And then there's so many different ways in which people are going to say, listen, that's been a great model for a handful of people, digital advertising, or a handful of companies over the last 25, 30 years or whatever. But all of a sudden with a chatbot, there's lots of potential conflicts. The other thing is that if subscription is the major revenue generator right now, it's not likely that billions of people are going to pay for it, right? And so if you think about overseas where 2/3...
Especially when Google's giving it away for free.
That's right. And when 2/3 of their users and incremental users are going to be outside the US, this as well as anybody, the average revenue per user, the ARPU for all of these platforms, these digital platforms, you know what I mean, is much less overseas than it is here. And there are, at some point, forget China and all this, people are going to have to focus on what is the business model? How does this company, at the scale at which it is, how do they ever become profitable?
Well, I think that's why you've heard Sam Altman talk for so long about reaching AGI, and that is sort of the North Star, but a little bit less so. Now they're talking about like way less sexier stuff like enterprise adoption, and they're late to the game there. Anthropic has just been a force in enterprise AI, to the point where even now Microsoft is partnering with Anthropic because they see it, and they need to just make it sticky. There's Anthropic on the enterprise side, and then there's Google Gemini on the consumer side. And looking at some similar web data today that just shows, Google gaining kind of shockingly ever since they put out Gemini 3. And I don't even know if that's so much about people switching chatbots or just like you said, getting served a free chatbot when they go to Google search. Like when you do a Google search now, it says, do you want AI mode?
Yeah.
And you click yes, and that's kind of the default. And then all of a sudden you're a Gemini user.
Yeah. I use Gemini. I like it across a lot of the, Google, services that I use. I recently went back to ChatGPT for a lot of more specific things as it relates to my work. So, again, Gemini is probably going to be one of those things where you don't end up paying for it. There's other ways they're going to monetize you, right, to give you that service. ChatGPT is good at what it does. I mean, I think it's the best at what it does. A lot of folks, point to Grok. I'm not going to be using Grok anytime soon. So again, I think your point about AGI is also a good one, because once we get there, or one of these, kind of labs
whatever that
get
means.
there, yeah, they're all going to have different definitions for it. They're all going to have different use cases for it. And then they're going to be quickly, and there's going to be, I think there's going to be a lot of debate about it. And so to me, I think Google has been one of the largest beneficiaries of the last 6 months about the narratives in and around this. And because of they don't need to build out these data centers with using a ton of debt, like the way Meta is and the like. And so to me, I think that Google probably remains the cleanest story, but it's also one of the ones where there's the most euphoria at the moment. And on the flip side of that, Microsoft and Meta can't get out of their own way, and they are two of the worst performing stocks in mega cap tech in the last few months. So I'm just curious.
Meta will be so interesting this year. I don't know if you've been following Jan LeCun too. Yeah. There was, it's AI scientist that left and just keeps talking smack, whatever he wants to say, around saying that LLMs aren't even a path forward. They're overhyped, and he's just been it's a rough spot for Meta.
I mean, listen, it's just a really amazing tool. I use it all the time. Just summarizing things and writing them and making notes about them, and really just helping you think about it in a much more clear way.
And to bring us full circle, I mean, yes, it is amazing, but that's why I've sort of enjoyed watching the footage come out of CES this year, because that is the next evolution of AI. It's physical AI. And when you see sort of this Boston Dynamics robot named Atlas, what it's going to be able to do in the future, I don't know when we get there, but the idea that you can teach it a task in one day, it can go do that task, and then it teaches it through software to all the other Atlas robots that exist. That is really interesting. That feels like a real use case for reasoning, for agentic AI, that it's harder maybe to see through your chatbot at the moment.
I mean, one thing I'll just say, and I was reading this, I can't remember where I read it, and I feel, I hope whoever I read it or was talking about it, that if they're listening, I will give you credit the next time around, because I'll go back and look at it. But, humanoid robots are interesting. I met the CFO of Agility Robotics, and it's a great company that actually has robots in use right now in factories, so really industrial uses. But what I read over the weekend was that humanoid robots with legs are really dangerous, because they can easily fall over and they can really hurt somebody. And if you're Optimus, like for instance, let's say you're meant to be in someone's home, and Elon says that everyone's going to have one or maybe two. If your legged humanoid robot falls over and kills your cat, you know what I mean? It's not going to be the sort of thing that, you're like, all right, I need two of those, you know what I mean? So it was just kind of an interesting thought,
I thought you were going to go somewhere else with that. The more extreme version, I don't know if you've seen the Unitree robots out of China doing roundhouse kicks and just absolutely smashing this watermelon in the demo. Those are straight up terrifying and remind me of that Black Mirror episode where, even the robot dogs are running around killing people.
Yeah.
But yes, what you said is a less extreme version of that. It reminds me also of the video. I don't know if you saw a humanoid robot walking into a mirror and shattering the mirror. If you have kids around, that's dangerous too. And there is so far to go. Absolutely. I think everyone agrees on that. 20 years plus before you have a humanoid robot in the home. But the industrial use case perhaps is more interesting at the moment and closer.
Listen, you've heard me say this before. I mean, all this stuff will happen, right? And there'll be, speed bumps, no doubt about it. But I take the over, all the time with this sort of stuff. Just to finish up here, Dee, I wanted to get your take on this, because this hit, Guy and I were talking about this on a podcast earlier today, and we were talking about just kind of some of the trepidation that, I think institutions are having right now about continuing to pile money into, let's say, these mega cap tech stocks and the like. And as we were discussing it, an FT article just came down. Fund managers prepare for reckoning in U.S. tech sector. Some investors reduce positions or buy protection for their portfolios amid concerns over valuation. So again, that is no signal to sell, you know what I mean, by any means. But, you know, one of the points that I think is underappreciated right now is that, yes, we can all see how Meta trades or Nvidia trades or Microsoft or SanDisk or, you know, Oracle, whatever the hell it is, right? And we can all make judgments about that. We can all manage risk in a certain way that makes sense to public market investors. But there's a pocket of risk that I don't think is being appreciated that has the potential to really affect the public markets. And obviously that's in the private markets. And we just mentioned this. Where do they raise all their money from? VCs, where do they raise their money from? Pension funds, insurance companies, you know, all that sort of stuff, right? And so if you start to see down rounds in some of these mega caps, well, what do these companies do? Or you see greater interest in them. And, you know, SoftBank's a great example of this. They had to fund Stargate last year or the end of last year. They made the final payment on December 30th of $22.5 billion. They were desperately trying to raise the money. They had
to sell. That's such a Masa-san move.
Yeah, but they had to sell their entire position in Nvidia. They had to sell.
I mean, but that's, Masa-san will do that over and over again in every single tech cycle. And, you know, he'll make one good bet to come out on top. That was ARM in the last round. Yeah. But, you know, we heard a lot about WeWork. It's going big. You know, it's choosing now. It's going actually to the infrastructure layer and OpenAI. To your point, though, I mean, like, how much risk, is that what you're asking, are in the private markets?
Well, no, I mean, there's obvious risk there, and there's dozens, if not hundreds of companies that have raised cumulatively, you know, tens, if not hundreds of billions that are going to go out of business. It's just going to be like poof, right? But the flip, what I'm most focused on as a public markets investor is that when you see, you know, when you don't have liquidity in those markets, you don't have transparency, right? You're going to sell what you can sell, which would be public equities. You know what I'm saying? And so I think that there's this potential knock-on effect. We've seen it in past cycles, but this one could dwarf that. And Masa is a great example. He invested at $250 billion. He's investing at $500 billion. He's going to invest at $850 billion. He's closing out some of the other bets.
You're saying public market investors could take money out of the public markets in order to get some of the upside in private?
Yeah, I mean, like, or that's under like. So here's a positive example where Masa is basically saying, I've had this huge return in Nvidia. I believe in this story. I believe in where they sit in this story, but I'm going to take my profits there and I'm going to move it into something that it's Nvidia 7 years ago for me, right? So that's under a positive scenario. The flip side of this, the thing goes pear-shaped, this whole trade, right, to some degree, and then they sell what they can sell to raise money. And so, you know, and I'll just make this last point because it goes back to the semblance thing that you just talked about, the metaverse moment and this and whatever. You know, people forget that Tesla and Netflix and Nvidia, right, and Meta, they sold off 70% from their highs, okay, in 21 to their lows in 22. And to think that can't happen again is just silliness. And you could say, well, it's different. Well,
see, I actually take heart from that because I know that was a really tough year. But if you had just, again, I go back, if you had been in them for the last 10 years, you would be fine.
Yeah, most investors don't invest that way, right? So they pile in when it's euphoria, and then they make really bad decisions when it's just despair. And, you know, like SanDisk is a great example, or Micron's a great example right now, where you're seeing folks pile into these names. And what do you think they do when the thing is up 500% in 6 months? Do you think they sell down 20%? Do you think they sell down 50%? Where do you sell?
Fair enough. But there's your sort of answer for the retail investor, which is who I like to focus on too. Just don't try and time this. An interesting point though, I just want to bring up, but I know we're running out of time. This is something that I covered yesterday on Tech Check, just how the pace of startups, AI startups going public in China, it creates a really interesting sort of contrast to what we're seeing here. OpenAI is now based on its private valuation, that is like 850 billion, perhaps, at its next raise, one of the biggest companies in the world, public or private. Yet no transparency. We're just guessing at demand and then trading Nvidia and Microsoft and Oracle. We don't know, how the numbers are changing. We don't know what the balance sheet really looks like. And then in China, you have these companies, these new chip makers, these actual model builders that are going public. First it was Shanghai and now it's Hong Kong. And it's just ironic that we're seeing more transparency from them. And that's interesting because the markets, you could argue, will keep the risk sort of a little more rational than just VCs or strategics bidding them up because they can.
Yeah, and the last thing I'll just say on that front is that there's a lot of takes about what this situation in Venezuela means for, right? If it's about oil, it's about rare earths. What does it mean for China and what they might perceive their prerogatives are as it relates to Taiwan? What does it mean from this trade war? Because if the trade war really is about rare earth materials and soybeans and chips, might the Chinese just say, okay, we're going to put tighter, export restrictions on, rare earths. Okay, well, then all of a sudden, what do we have to do? Well, might we put sanctions on an Alibaba or a Baidu or some of these other companies that are perceived to have, a lot of reliance or connectivity to the Chinese military? So there's a lot of potential for things to get dialed up a little bit. Obviously, we've had, oddly, TikTok at the middle of this whole trade war, which is so obvious. So again, it'll be interesting to see how a lot of these Chinese issues, how they trade and what sort of demand there is foreign-wise.
Yeah, absolutely. Couldn't agree with that more. I think that's going to be a huge theme this year.
All right, Dee, we covered a lot of ground. I appreciate you taking the time. I know you do this in between your tech checks and, on and off TV. So we appreciate it. So thanks so much. We'll see you next week. I appreciate it.
Thanks.
All right, welcome back to OK Computer. I'm Dan Nathan still, and this is Jeff Richards. He's managing partner at Notable Capital. Jeff, welcome back to the podcast.
Happy New Year. Great to be here.
All right, you know this, and I'm just going to tell the people, you are one of my favorite podcast guests for a whole host of reasons. And one of the main ones is obviously you invest, you're a prolific investor in private tech companies, but you also have a great eye for what's going on in the public markets. I know you speak to a lot of public market investors, and your ability to kind of put, some themes together that's maybe more prevalent than one versus the other. I find it really helpful. We've gotten great feedback from our listeners, so I really appreciate you being here, Jeff.
Awesome. I always love chopping it up, and no better time than right now because we got an exciting year ahead of us.
We really do. I mean, it's funny, and that's a great way to phrase it. We're going to talk a lot about the stuff that interests you, obviously, in the private markets and extrapolate some stuff, like I just said, to the public markets. But, last year in public, it was much less interesting than the prior 2 years, in my opinion, and maybe there was just a bit more dispersion. Deirdre and I were just talking earlier in our conversation how 5 of the 7 Mag 7 underperformed the S&P and the NASDAQ. And then we saw, a rotation into other parts of technology, certainly not software, and you and I are going to discuss that. But, you saw it go from, let's say, Nvidia on the chip side, and it really broadened out on the chip side. And we had the hyperscalers, right? And then we had the neoclouds, and then we had the server makers, and, then we had the energy trade. That was something that I don't think a lot of folks in 2024 saw coming, right? And then there was a whole host of other things in and around actually the build of data centers. But now what is raging, and it's been doing this for like 3 or 4 months, especially as some of these other names have gone sideways, is storage, memory. I mean, the gains in whether it's SanDisk or Micron or, a whole host of other names is just, it's crazy and it feels like a mania. So thoughts on that as far as the rotation we've seen in and among tech, and then we've seen underperformance by some of the early kind of market cap gainers of this kind of cycle, I guess.
Well, it's interesting. Last year, I thought it was a pretty wild year. I mean, given the drop in April around Liberation Day, what was the NASDAQ down 20% from the start of the year till April, and then went up 20% from there, or whatever the number was. And we ended up with a pretty good year across the board. So it was a great year if you were a buyer of things that were working when they hit their lows. And, as somebody who loves to buy low and really, I don't even sell high. I just hold. But I hope we'll have another dip like that this year. I think the interesting thing about you mentioned there was the October lull where people got concerned about OpenAI and Oracle. You saw Oracle trade down meaningfully. You saw some of the scare around private credit. You saw the PE names trade in a pretty mediocre range, if not down last year. And obviously some of them, like Blue Owl, have big exposure to this AI build out and CapEx build out. So to me, it's just been fun because, as you mentioned, software has been a big laggard. I mean, software, mid cap, small cap software, even the big names like Adobe and Salesforce have not done well. And yet, I think everybody believes at some point those companies do well when companies are buying more in the AI universe. So I will tell you from the private market perspective, which is obviously where we spend all of our time, things are pretty exciting. We had a lot of companies that had very strong growth years. We're seeing a ton of adoption. And as you and I have talked about in the past, I think one of the big gaps in the public market is just, you can see the infrastructure build out. You can see that sort of next generation cloud layer build out with AWS and GCP and Azure, and a little bit of it with companies like Snowflake. But the top layer where the true end demand is happening, I would argue 99% of that is happening with private companies in vertical software, private companies that are innovating in various parts of the ecosystem, putting things in people's hands. And then we haven't seen anything really other than ChatGPT in consumer. So ChatGPT, one of the most successful consumer product launches of all time, but we haven't seen the Uber, DoorDash, Airbnb, et cetera, of AI yet. I think we'll start to see hints of that this year.
So some of the stuff that you guys are investing in right now is more of that sort of, if you want to call it that, application layer, right? And so just kind of explain that a little bit, why that might be under the radar a little bit if you're staring at, your FactSet machine all day long and you're looking at semis go up every day and you're looking at some software names that were the darlings of the stock market, right, for the last 10 years or so, and there's no low that seems low enough for them. So where is this kind of disruption happening? Because it's not that frequent, at least in my career, where public market investors are speaking with their wallets in their markets, but they're looking over there in the private markets and they're saying, we see disintermediation, we see disruption coming. So kind of help me kind of like bridge that gap a little bit.
Well, I think, look, the big challenge is there's no data for the analysts to work with. There's no data for the investors to work with. You don't have, imagine if we had 10 or 15 AI native software companies that were public with $5 to $10 billion market caps that were growing at 60, 70% a year, and they were beating and raising every quarter. There'd be a very different energy right now. Mm-hmm. But we don't have any of that. There's literally not a single public software name growing at north of 30% other than Palantir. And the ones that people are still even reasonably excited about are growing at 20%. And you've got companies like Salesforce and others that are, probably without acquisition, probably sub 10%. So there's not much for people to get excited about in the small and mid cap and even large cap software name, other than Microsoft, some of the CrowdStrike, Palo Alto Networks on the cybersecurity side. And by the way, I do think cybersecurity is a huge winner in the long run with AI. So many issues with cybersecurity, and I think that trade is going to continue to work. And you obviously saw Google pay a big price for Wiz last year, one of the largest M&A transactions in private market history. I think is a harbinger of probably other things to come, and we've seen a number of other deals get announced in the last 90 days. So I just, as I made the point to you earlier, like if you're a public market investor fishing in software right now, you're really not fishing in very exciting waters. You're fishing in a river in Fresno. And the private market investors are getting to fish in, name your, Alaska, mm-hmm. Colorado, Montana, Patagonia. That's where all the action and all the excitement is. And I think, in an ideal world, some of those companies will go public this year. I don't know that will happen because it's still so easy for companies to raise private capital. But ideally, late 26, 27, I think people would be, how would we even start to think about the valuations for those companies? I mean, you've got good companies growing at 20% in the public market in software. They're trading at 10 to 15 times forward. What's a company growing at 60, 70, 80% going to trade at? We don't know that yet, but it's going to be fun to find out.
Well, I mean, if Palantir is any sort of indication, I mean, on last year, let's calendar 25, it's trading at 97 times sales, right? And it's trading at like 68 times projected sales. And to your point about the growth rate, and one of the few that are growing above 30% annually as far as revenues are concerned, this is off a really low base. In 24, it did less than $3 billion. 25 is expected to be $4.5 billion. 26 expected to be $6.3 billion. Even if you were to say that 6.3 is going to be 7.5 or something like that, it's kind of like a rounding error. You know what I mean? To me, I definitely think there's potential for dislocations. And, I guess the good thing to your point about fishing, and I'm not a fisherman, but I'll take your word for it, that the Fresno River is not particularly a great place to do that. So I wonder if you did see a bunch of those companies that you just described go public and what that might mean for a name like Palantir, right? Like, we get it. Their business is doing really well. They have a management that's telling a great story. They have a customer base, on the private side that is growing and adopting that product that so many investors are excited about, right? On the AI side, we know that, the government stuff It's going to continue to come, for a lot of the same reasons that you just mentioned about security, right? It feels kind of nascent in many different ways. But if you were to see a bunch of these companies come public and they're $5 to $10 billion, you might see a lot of capital gravitate towards those, which would bring us back to a period I don't even remember, and maybe you can help me think about this, but in the late aughts, early tens, was there a bunch of SaaS companies that came public, at sort of market caps where people feel like they didn't miss the boat, Like we definitely saw that a bit early. So talk about that.
I mean, go back to ServiceNow, went out at a couple $1 billion market cap. You had HubSpot that went out at 700 million. Today it's a $30 billion company. Companies like Twilio that went out at $1 billion eventually went up to 20, 30 billion. So, again, 10, 15 years ago, that was the rate to raise growth capital at scale, was to go public. And one of the challenges, this is not a new insight from me or from you, but one of the challenges we have in the private market today in terms of getting companies to go public, we were talking about a company in our portfolio yesterday, could easily go public. Great metrics, great growth, very much at scale. And, been talking about potentially doing an IPO, and had an investor offer them, hundreds of millions of dollars in the last couple of weeks. No real process,
Right.
No regulatory oversight, no roadshow. So it's very hard to say to a management team, turn down, $500 million at a great valuation that's might even be, it's probably less than what you would get at an IPO, but it's not way less, when it's easy for them to do. And so I think what you're seeing right now is so many of the crossover funds and even some of the large public investors, the T. Rowe's and the Wellingtons and others, Fidelities, are doing some of these rounds as well. That is today's small cap public software stock, is a company that's private that's raising at 5 to 10 billion. I personally don't think it's great for our economy. I wish more people could own these names. I wish your average Schwab investor or Robinhood investor could buy into these names and own them when they're at 5 billion or 10 billion. Lord knows we used to have companies like Amazon go public at 500 million.
It's crazy.
But so much of the growth is happening while they're private. And then the offshoot of that, as I mentioned earlier, is that the data around their growth, who their customers are, what they're buying, why they're buying, and the growth metrics aren't going to analysts, which can then churn those into their market forecasts for things like AI. So there's just this huge opaque layer above the chip infrastructure, Amazon, Azure, AWS, GCP layer, where really one of the only proxies people have is Snowflake, which is a good proxy. And Databricks obviously is the private version of Snowflake and growing faster. But those are two companies, by the way, I think will do very well with AI. But there isn't much else, because pick a small cap software name today that you believe is more than 50, close to 100% pegged to AI. There really isn't any.
Right.
And so, and then you've got categories like SMB, which should be big adopters of AI, 52% of our economy, or 55% of the employment, and 42% of the economy. You can buy into it. You could buy Wix, you can buy Shopify, but those are companies that have been around for quite some time, and you can't really argue that the majority of their business is tied into AI. So hopefully what will happen in the next 6 to 9 months is a few of these companies will say, you know what, we want to be long-term durable companies. We want to go public. And I think what they'll find is that the valuation for their business will be higher than what they expected. If Palantir is any reasonable proxy, you don't need 97 times. But if you were to go out at 20 or 30, I think a lot of people would say, I'll take that.
All right, so you just mentioned IPO market maybe heating up towards the end of this year, early 27, and obviously that's predicated on a market environment, right? That is healthy, that looks like it does right now. Maybe there's a little more regulatory and political certainty about some things, and maybe that's something that, after the midterms kind of unlocks that a little bit, right? But I'm just curious, how you think about it, because, 2022, the IPO market got devastated, right? We had a hot market in 21. We had a lot of SPACs. I think a lot of people got burned in a whole host of different ways. And so off of this really low base from 22, we've seen incremental increases year over year. I think last year we were up, 100% year over year as far as probably capital raised. Does that make sense? I don't have the data exactly in front of me. So what would you expect? You just said that, a lot of these companies, especially in your portfolio, you'd love to see them go public. You guys need opportunities to kind of exit right names. You've been stewards of these capital of these companies. You helped them along that sort. What are you expecting, let's say, for the first half of 2026? Do you expect things? Was there a backlog, I guess, also with the government shutdown?
Well, a couple things. One, we certainly don't have an overly exuberant market when it comes to IPOs. I mean, I'm pulling up the data from Goldman Sachs right now. In 21, we had 261.
Mm-hmm.
In 22, we had 16. In 23, we had 23. In 24, we had 52. And in 25, we had 61. That's not just tech IPOs, that's just US IPOs. So it's, we're at a fraction of where we were in 21 and a fraction of where we were in exuberant markets like 99, where 99 there were 388. But the other thing we had last year that was pretty interesting is we had a record M&A market. So last year was the highest M&A market in history other than 2021. And I think if you think about a market where we have low rates or lower rates, we don't have low rates, but we should have lower rates given the direction from the president and others. It seems like the trend lines towards lower rates. You've got, as you and I talked about, I think it was last summer, I think we're at the point in a cycle where large tech companies are realizing they don't have the chops internally to build the things they need to build around AI. 23 was the year they said, wow, GPT is really interesting. Mm-hmm. 24 was the year their team said, hey, we got this. 25 was the year the CEO realized we don't got this. And I think you started to see M&A from folks like ServiceNow, from Workday. I think Workday did $2 or $3 billion acquisitions in the second half of last year. So I think you'll see more of that continue heading into this year. You saw Nvidia do the deal with Grok over the holidays. I think that trend will continue, and I think this will be another strong year for M&A. So that, again, competing for IPO volume is M&A, and then also private capital, which there seems to be almost a limitless amount of. And then you're now starting to see liquidity. Last year was a much better year for liquidity on the LP side than obviously 24, 23, and 22 were. As that liquidity starts to flow into the ecosystem, a lot of that gets recycled back into the investment community and gets put to work. So I'm sure at some point I think this year we'll start to have, and one of the things we'll start to see in our world is some of those companies that raised money in 23, 24 at very aggressive valuations now have to start to live up to the hype. They have to show that they have durable business models. They have to show that, one of the new things in software is this consumption-based pricing model, which Brett Taylor and Sierra have talked a lot about. Very strong model for getting new customer adoption. What we don't know is how long-term retention works. And the big metric in the software world is net dollar retention. Can you retain those customers over a long period of time? In the old world of SaaS, you'd sign a deal with Salesforce or whatnot, and you'd sign for 3 years and you'd pay for a year up front. In a month-to-month consumption model, you're paying as you go. Great for the customer because it's very easy to adopt. Looks great initially for the seller because it's very easy to bring the customer on board and you can scale very quickly. What we don't know is what retention is going to look like for those business models. And then, I do think that consumption pricing model is going to put pressure on the public companies who have seat-based models.
Yeah.
Because people are saying, we've met with several companies that are building AI, for example, in the CRM space. And they're going into customers and say, hey, we'll give you the CRM for free. Pay us for the consumption of the features on top of it. One of our companies that bought from one of these companies told us that their spend prior to this new purchase was around $15,000 per sales rep on their tech stack. They think under this new model, it'll be closer to $3,000. So I don't think that will hold up over time. IT budgets don't tend to go down, even though pricing models change. But in the interim, it could put some real pressure on the small and mid-cap public software players that have those seat-based pricing models. And that was obviously a popular trade with the hedge fund community in 23 and 24 and 25.
Well, to your point, and this might be one of the reasons why Microsoft has really lagged over the last 6 months or so. I think the information in an article a couple weeks ago talking about how Microsoft is basically they're going to have to pay a lot of these companies, a lot of their customers, their training and some other costs just to get, folks using Copilot, right? You read this, right? I mean, it's just like we're kind of at that point. I think that's the point you're kind of making here a little bit. So it'll be interesting to see if like a Microsoft starts getting into the acquisition game. I know they make a lot of small ones here and there. And, as a company that did not have to spend tens, if not hundreds of billions of dollars to kind of create a model, train it, all that sort of stuff, they might be in a pretty decent situation, especially with their arrangement with OpenAI. And OpenAI is obviously a huge customer of Azure. A quick one, just going back to the IPO stuff, because our friend Jesse Chassie over at RBC, who runs Tech ECM, he's been making this case, I want to say for like a year and a half, talking about a lot of the KPIs that you guys focus on, or maybe in different cycles, you'd be like pushing them out the door, you know what I mean, to go public, but there's been a lot of apprehension about that. Maybe it's just the kind of environment that we've seen. It's been obviously, from a macro standpoint, it's been a bit uncertain despite the fact that the markets keep just kind of powering on. You mentioned the private for longer. Okay, so this is all kind of tied up together. Where do you sit with that? Because obviously there is this dual track if you're kind of thinking out, let's say a year, 18 months to an IPO, but to your point about a lot of M&A going on. So I'm just curious, like how you shake out, or you're just open to any and all exit.
Well, look, we always believe that the best way to generate a long-term outcome for us and for our LPs is for a company to go public. You tend to see the most durable companies go that route, and they've put in place the management team and the product lines and all the other. And Bill Gurley talks a lot about this. Going public forces you to pay attention to the metrics that matter to have a durable business model. And if you look at companies like Palo Alto and CrowdStrike and ServiceNow that went public in the last decade plus, that's been a great path for them. We would argue it's easier to raise capital once you're public because you can use things like debt in a very efficient way. I think the challenge is when, your option is to go public and raise $1 billion at, $7 billion valuation, and somebody in the private market says, hey, skip the roadshow, skip the regulatory process, I'll give you $500 million at the same price. It's a tough argument. And the other thing that has become standardized in our world, which wasn't there 5 years ago, is the secondary market. So today, a lot of those larger rounds that you read about, Databricks, Ollie's been very public in talking about the rounds he's done at Databricks, having a large secondary component. OpenAI has done a lot of secondary. There's a very liquid market for early shareholders and employees in those companies. And we're starting to see that become more normalized, even in the $2, $3, $4, $5 billion companies that raise. And that's, on the one hand, that's a healthy thing. It's giving people liquidity, and it's also good for employees. On the other hand, it's not true liquidity like you have in the public market, and you're not really getting a mark-to-market price. So, what is it? Clifford Asness that talks a lot on Twitter about volatility laundering. You certainly have that in the private markets where valuations don't change much, and they tend to just go up. So there is a little bit of volatility laundering going on, and I don't think that's great for employees. You'd rather have people actually have price discovery. I don't know what would change it. You'd have to have a big regulatory change where it became easier and less expensive to go public, and I don't think that's probably in the cards. And then on the M&A side, we have not seen a lot of our company. We've actually seen most of the private equity firms not be super active in buying technology companies in the second half of last year. And I don't have a perfect answer for that, other than I suspect part of it is the cost of debt, was higher than it was a few years ago when they were more active. And I think the second piece is a lot of what they are able to buy are the pre-GPT companies that are at scale, but frankly don't have an exciting growth story ahead. So a lot of those companies that were funded in the 1920, 21 era that were pre-GPT have not pivoted into something new and exciting in AI. And they're still running a seat-based model that may not be the exciting thing that you want to bet on 3 to 5 years from now. So I haven't spent a lot of time talking to folks at large, tech private equity firms, but I suspect that's the challenge right now. And then for them, the companies that really are exciting, that are growing at 100 or 200% a year, they're simply not, you can't buy them because the valuation would be too extreme for their business model.
I want to go back to some of these SaaS names that you mentioned. So when you think about a Salesforce, you think about Adobe, you think about Workday and ServiceNow. These are all names that, you just mentioned here. They're all down between 30 and 50% from their all-time highs. So what do you think it is, if you're a public markets investor, if you think that, the hyperscaler and some of the chip stuff, has gone, and then some other things in the kind of AI ecosystem we just talked about, memory and storage and server makers and neoclouds, what changes the narrative around them? Because you have seen some M&A there. What is the sort of M&A you'd like to see from some of those names, if you think that they kind of had a plan to integrate, whether it's teams, whether it's tech, into what they are doing right now and change the narrative?
Well, I think, look, this is a conversation I had with a group of public investors yesterday. Ramp put out their Ramp AI adoption index, which shows adoption across, I emailed it to you, but their adoption across a bunch of different categories of AI going back to January of 2023. And what they show is technology companies now, and it says share of US businesses with paid subscriptions to AI models, platforms, and tools. Technology, 74%, finance, 60%, manufacturing, 45%, retail, 38%, healthcare, 31%, construction, 30%. So clearly these industries, it's not just tech, clearly every industry is spending money in AI. The problem is they're not spending it with those companies. So where are they spending it, right? If they're spending money, we have the data that says they're spending money. They're spending billions and billions, probably tens of billions of dollars on AI platforms and tools, and it's not showing up in the growth numbers for small cap software or even the large cap software companies. Where is it going? And I think the challenge right now for a lot of public investors is they say, well, it's not real. That spending actually isn't happening. I would offer an alternate theory, which is it is happening. It's just going to these private companies because we are seeing companies grow at rates that we've never seen before in our portfolio. And I know every VC says that because we all do. And not all of them are, but we literally have several companies in our portfolio that booked hundreds of millions of dollars in new business in Q4. And these are not the OpenAIs and Anthropics of the world. These are companies you've probably never heard of. So my argument is that spending is happening. It is real. It's just not being spent with public companies. And therefore, there's an information gap for people who rely on public company information to gauge how well a market is doing. The question you asked, which is what turns it around, I personally believe that there's just a huge cultural gap for companies that are operating in this new mode. They're these sort of 996, they're in the office 24/7, they're building in very rapid deployment models. And, some of these are very public. We have a company called Vercel, which is doing very well in the AI infrastructure space. They're constantly publishing new product data, new product launches, new features, new functionality. They're moving at a pace that these larger companies just aren't used to. These larger companies are used to annual product releases or quarterly at best. These companies are doing it daily or weekly. And so I think what you're going to see, and this goes back to your question about M&A, at some point, those larger companies are going to have to suck it up and say, look, we don't have the team to execute to win in the market that is, where the puck is going in 3 years. We're going to have to go pay 30 or 40 or 50 times revenue for one of these upstarts to bring them in and have them come build this. This is not new, by the way. You saw Zuck do this with Alexander Wang at scale. You saw Ali at Databricks do this in acquiring Nikita and the team at Neon. So these data points are there. We just haven't yet seen some of the traditional names do it. And I think the real question is, can the companies that are at 5 or 10 or $15 billion market caps, can they even afford to do that? Because right now they can't go out and get the talent. Talent is all going to these newer companies that are very excited about the equity and the upside and the culture. They can't recruit the talent. They need to go buy it. But can you afford to pay $2 billion for a 10 million ARR business when your market cap is only 15? That's probably a tough argument to the board. And so I think there's a little bit of a challenging narrative for a lot of these companies that are in that small cap universe right now.
Where do you think some of the industries that are spending on this technology, that are getting, benefit from it right now, they're being able to demonstrate that? Because, there seems to be this idea in a handful of different industries, verticals, where productivity is going higher. The idea that, a lot of these companies that are doing very well have no intention to raise, employment, year over year. And we saw, even that comment from from the CFO of JP Morgan, I want to say a month ago at an industry conference. She mentioned that, expenses are going up, on primarily tech spend, not on hiring people. That used to be a big part of that, kind of spend. When you see that, and by the way, JP Morgan sold off 5% in 3 minutes or something like that on that. Now
it's up this year though.
No, it's come back and it's well above that. I'm just curious, how you're thinking about different industries and where you think the biggest drivers of some of the growth that of the companies in your portfolio, but also going back to some of the public names that we track every day.
Well, I think it's no accident that the finance names are starting to, I think people are starting to understand that AI is going to be a big tailwind for finance and banking. Just think about all the functions, loan processing and customer service. I had a nightmare with my unnamed credit card company over the holidays and sitting on hold and then talking to somebody live. And then I had to call them again. I'm like, this can all be solved with AI. So finance, it's not surprising to me that ramp data shows finance is at 60% adoption already of AI tools. Clearly, that started probably in 24. It continued in 25. It'll accelerate in this year. And I think you'll start to see, the metrics that people pay attention to, whether it's ROIC or, whatever the metrics are that the people who follow those companies are going to start to say, wow, we're starting to see improvement here. We're also seeing it, though, the point I made earlier, 45% adoption in manufacturing, 38% in retail, 31% in healthcare. Healthcare, to me, is one of the most obvious use cases. It's going to obviously, hopefully benefit us as consumers as well.
Mm-hmm.
All the process and the infrastructure and the billing and the overhead that is built into all the administrative layers in healthcare, so much opportunity there to increase efficiency with AI, and then, give you as a consumer an incredible experience, right? I'm now wearing my Aura ring, which my wife gave me for Christmas. I got a good night's sleep last night preparing for the pod. But all that data is going to start to be collected and give you very real-time information about what you can do to manage your health in a more proactive and better way. By the way, tons of companies getting funded in that space, so I'm super bullish on that area. But also in the back office, we have a company we funded called Plentful that grew 3x last year. Software for healthcare. They're dealing with pharmacies and pharmaceutical manufacturers and various health insurers. So I think these categories are very big. I think what's the question you have to ask is, okay, healthcare, is any of that new AI spend going to go to the traditional healthcare software providers, or even the folks like SAP who usually play in that space as well? I think that's a big TBD. I don't think people are going to suddenly say, I'm going to give SAP $100 million to revolutionize my billing process with AI. The time that it would take to do that, in a traditional software universe, that's a 3 to 5 year project. These companies can say, hey, we can have you live in 90 days. Mm-hmm. So it's just a very different paradigm. I think it's going to be very disruptive for a lot of these companies. And I think it's why it's going to drive a lot of the M&A. But it's going to come back to the point we made earlier around, if you're a $15, $20 billion market cap company, can you pay $1 billion or $2 billion for a 10 million ARR business that's landing new business with all of your customers? I think that's where the rubber's going to meet the road.
Well, again, speaking to you, I've heard 10 names that I've never even heard of in the private market, and it really is illuminating a bit, because what I do all day long. I stare at screens, I talk on podcasts, I talk on CNBC, and we're kind of sick of talking about the same 50 names. You know what I mean? And it would be interesting just to see some of these metrics, see some of these growth rates, see some of the folks that they're partnering with, see where they're hiring talent from. I mean, the list goes on and on. See what public market investors.
I mean, if you had the companies if you had OpenAI, Anthropic, Databricks, and companies you may not even heard of, like Vercel and Harvey and Open Evidence, and if 10 or 15 of those companies went public, I mean, you'd have a field day on CNBC. You guys would have more than enough to talk about. And I think what it would do is it would give people insights into why all these industries are starting to spend so much in these categories. But until they do, there's just a huge information asymmetry. There isn't anything to talk about other than headlines in TechCrunch and the information, which often aren't even accurate.
I had Jim Lanzone, a CEO of Yahoo. I'm sure you're
Jim's great.
He's a man. And we were talking a little bit about internet history, going back to, let's say the mid to late 90s. And I didn't realize this, but I don't know what that means exactly. But, Yahoo, the company formation was like in early 94. Maybe it was the guys were working on it in 93 when they were at Stanford or whatever. The company went public in April of 95. I mean, just think about that, right? You know, and think about what the market cap must have been. I don't even, off the top of my head, tens of millions, I don't know, 100 million, whatever it was. It sure would be a more fun environment for public market investors if that happened.
And I think that, I mean, such a great point. And I was in Silicon Valley at that time. I mean, you had companies going public with 50 million of revenue or 25 million of revenue. Think about how mature those finance teams were. I mean, how immature those teams were. The companies we're talking about today have billions in revenue, hundreds of millions of revenue at a minimum. They have great finance teams. They have all their processes in place. They have all the things that you would look for in a well-run company. So I guess my other hope is, and I'm sure we'll have, you mentioned the 21 era where we had SPACs and all kinds of things that went out. I hope we don't get to that level of exuberance. But I do think if a few of these companies go out, one, I think people would be surprised at the valuations, because I think there's just an absolute hunger for new ideas and new names and new things to get excited about. If you're a public analyst, you're kind of tired of modeling software growing at 11%. It's getting pretty old, right? And there's not a lot of beat and raise going on unless it was on lowered expectations. What you want is new companies going out with sort of an unknown opportunity set and a much bigger TAM in front of them than anybody expects, which is what will happen. And that's what we're seeing, and that's why it's exciting.
You know, it'd be interesting if you had, let's say, 100 tech companies go public, let's say in 2026, right? And all these analysts that cover them on the street, let's say they did not need to hire new analysts to help them cover existing. They literally spent $200 a month for GPT, Pro or whatever the hell their big thing is, because you keep hearing that Ben Thompson at Stratechery, I know you probably read him every day.
Love Ben. He's great.
He was doing some tests, I want to say early last year, really trying to replicate what a junior analyst might do as far as tech, and he was like, it's pretty good. Yeah. You know what I mean? Like, I don't think he wanted to kind of, dissuade any young aspiring tech analysts or, anything like that. But we're probably on the precipice of that.
I think, well, so not only that, but how many smart people can go build a Stratechery? I mean, what Ben has done is incredible, by the way, to recommend for all your listeners. If you don't listen or subscribe to Stratechery, I highly recommend it.
It's too cheap. I met him once, by the way. Actually, he was talking to Bill Gurley, and I was with a friend who was friendly with Bill Gurley. We're at Recode. You remember our
Yeah, of course. Yeah, Kara Swisher's event. Yeah.
We went up to him, introduced myself to both of them, and I was talking to Ben, and I'd been reading him at that point. This was like 2018 or 19. I had one comment to him. You could charge so much more for this thing. I mean, it literally is $10 a month, which is crazy, right?
I read it every day. I listen to his podcasts. He's always got incredible inside baseball. But I think, what's kind of interesting is you think about that as a use case of how many other people can now go build a Stratechery in various categories. Maybe we'll have a Stratechery for the healthcare IT industry. Maybe we'll have one for, because even the production of the podcasts, the production of the videos, all the content and everything. I was listening to a podcast the other day, and they said that the people in the LA who should, everybody's talking about the decimation of the movie industry with AI. And this guy said, yeah, unless you're a writer.
Yeah.
Because now as a writer, you don't need the distributor and the producer, and you might not even need the actors. You can produce all this stuff yourself with your ideas. So I think we're going to go through. Obviously, there was a very big narrative last year around job loss and AI is going to kill jobs. I think we will go through a cycle where that is the case in the near term, where you will see companies shedding jobs because they can become much more efficient with AI. But on the other side of that, I think what you'll see rising is, whether they're people setting up e-commerce businesses on Shopify or the next Ben Thompson. I just am super bullish that, particularly if you're young, and you've been using these tools in college and you're coming out of college and maybe you get a year or two of work experience and you say, hey, I'm in this really interesting niche where I think I can create my own business. I don't need to hire a finance person because I can do it with AI. I don't need to hire a marketing person because I can do it with AI. Mm-hmm. I can suddenly run that business and maybe do a few $100,000 a year in revenue and drop 80% of it to the bottom line, which goes to my pocket. So hopefully it's like this really interesting surge in entrepreneurial activity in our country, which would be awesome, I think.
I'm just curious, before we move away from tech for a second, it seems like the financial media, let's say more geared towards, Wall Street in particular, are just, nonstop talking about when the bubble will pop. There's not a lot of time spent on defining what a bubble is. You were an entrepreneur in the 90s. I'm sure you were just spending as much time looking at Yahoo message boards about the stock market as you were about building your company. Maybe not you, but maybe some of the folks that worked for you.
A lot of people were.
Yeah. No, I remember. But how do you guys think about it? I mean, is it something, are we, because we're mark to market every day and because some of the, the kind of biggest names in the market have accrued most of the market cap around this theme, we just spend too much time thinking about it? And would it matter if you had a considerable, take away the M&A, take away maybe like multiple compression, that sort of thing, and what that might mean for, some of the, you just mentioned, you didn't throw Stripe in there, but Databricks and, these are massive companies that have chosen to stay private for longer. Would some sort of pullback or a meaningful pullback that wasn't like a V reversal like we had in April, would that kind of need to affect, let's say the public markets need to affect private market valuations, but also innovation? Because that's the thing that you really care about.
Yeah, I guess the question I would ask is, what is the bubble?
Yeah.
Like we just talked about, the IPO market isn't in a bubble. We're not even close to the historical median in the last 25 years is 101 IPOs per year. We had 61 last year and 52 the year before. So we're not in an IPO bubble. You could argue we're in an M&A bubble because it was the highest on record, but most of that was not even in tech. Certainly high levels of venture capital funding for private companies, but a lot of that is due to the fact that it's going into companies that are later stage companies, and they're raising tons more capital than we used to see in the venture capital industry go to what I would call sort of true venture capital, Series A, B, C, and maybe D. Nvidia is trading at a lower multiple today than it did 4 years ago. So where is the bubble? I'm not saying there isn't a bubble, but it kind of feels like it's sort of like AGI. People are like, where's the AGI? And I'm like, well, have you ridden a Waymo? Because it's kind of, 10 years ago, that is what we would have defined as AGI. So I feel like in 99 and 2000, and as you mentioned, I moved to San Francisco in 95. So I was in the middle of it. I was an entrepreneur. I was a founder. I raised $125 million for my first company in 99 and 2000. The biggest thing there was every company that went public, whether it had 5 million or 500 million of revenue, got valued like it was the next whatever, Cisco.
Yeah.
Because I was going to say Google, but Google wasn't public yet. And so I think, and then the other part of that was odd in hindsight was there was only 200 million people on the internet. So the end market wasn't there, right? When I was telling you the stats from Ramp, you would have never seen a chart that showed manufacturing and healthcare and retail and these non-tech industries. If you measured adoption of the internet by those industries, it would have been in the low single digits at best in 2000. Whereas today you're seeing 40, 50, 60% of AI just 3 years into it. So I'm not saying, I'm sure somebody could tell me, hey, we're in a bubble and you're just ignorant. But the things that we normally associate with a bubble, too many IPOs, companies are way overvalued. You mentioned earlier the Mag 7 underperformed. What was it? Only two of the Mag 7 outperformed the S&P 500.
Yeah, Google and Nvidia.
Yeah, so you find these pockets. You mentioned SanDisk, which I don't follow. I don't really do much in hardware. You find these pockets of exuberance. Quantum computing is another one that I would point to that people got wildly excited about last year. And when you really press them to define what it is and why they're excited, it becomes a little squishy. So there are these pockets of exuberance, but I'd say overall, as long as we keep having solid earnings growth, which we had last year in the S&P 500, honestly, the biggest thing that scares me is that the government has $38 trillion in debt.
Yeah.
That's not under my control or your control, but that's the one I worry about the most in terms of our risk to the long-term health of our economy is just the amount of money we're spending on interest expense around our debt just feels like it's going to sink future generations. But hopefully somebody smarter than me will figure that out.
Yeah, well, Scott Bessent's on it. One of the things that's interesting, and just on that point, is when rates were going higher in 22 and in 23, that was like a topic du jour. A lot of folks were worried, how do you finance that with rates going higher? And now, you have maybe we're in a rate cutting cycle. Obviously, in 24 and 25, we have seen, nearly 200 basis points of cuts. And so expectations are not that aggressive for next year, maybe 2, maybe 3 cuts expected. So we'll see about that. But most folks, just anytime you bring that up, people just so dismissive about it. You know what I mean? Because we're going to be at 45 trillion in a year and a half, or, that sort of thing. So again, sooner or later, it's got to weigh on growth, right? And supposedly we see growth accelerating right now.
And it drove so much inflation. I don't know if you saw the MIT study I put on Twitter, but they really took a long look at what drove the inflation from 2020 to today. And so much of it was driven by that government spending. And so I just worry that is driving the cost of housing, it's driving the cost of healthcare, it's driving all these things that are making it the affordability for the average family in America it's hard to see. Now, you could argue that austerity around government spending and cutting benefits would be a challenge on the other side of that coin. But if you look at since the launch of the internet in 1995, average household income in the U.S. I think has gone from like 37,000 to 90,000. It's a pretty dramatic rise. And before that, it had not risen like that at all for decades. And you'd say, oh my gosh, incomes have more than doubled per household in the last 20, 25 years. People must be loving life. But they're not, because housing's gotten more expensive and childcare's gotten more expensive. And so I think we got to ask ourselves, what is driving that inflation and how do we try to put a lid on it? And obviously the categories where we have very highly regulated industries, education, healthcare, housing, is where a lot of that is. So is there any way we could bring more of a free market mentality to those markets? And, I tweet out probably way too often, people get tired of it, about housing. We stopped building houses. Mm-hmm. I mean, you look at the per capita building of houses in California, it's a fraction of what it was 30 years ago. So it's no surprise that the cost of houses, the price of housing has gone up for the consumer. We've got to get back to a mode where, and even folks like Ezra Klein with his book Abundance have come out and said, guys, we have got to get back into a mode where we can build things, because that's how you bring the cost of living down for the average consumer.
Let's look outside of tech for a second here, because I know over the years you've given us some really great insights into sectors that you've been invested in for decades that have nothing to do with what you were practicing or what you invest in the private markets. What are some areas that are interesting to you? You mentioned, in the private equity space, the alternative, lending space and the like, underperformed last year. And, that in a rate environment that was coming down. You mentioned that maybe some of the activity was likely slowed because of the rate environment, that sort of thing. What are some areas that, maybe that have not performed well that kind of interest you now, or some other areas, whether it's industrial, some other spaces, healthcare, that sort of thing?
Yeah, look, I continue to love the alternative asset manager space. I on a personal level, it's one of my largest areas of investment. And I just think that as you think about them doing more in private wealth, I think what happened when SVB collapsed, they took over a lot of the debt market for business, and that's why private credit became a thing. Or it was already a thing, but it expanded dramatically. They filled the void that was often had been filled by banks before that. And then I just think you look at a better liquidity and exit environment, whether it's M&As or IPOs. I think that's good for those folks as well. I think if I go back and look at KKR in Q4, I don't have the numbers in front of me, but I think their private wealth business grew by 100% year over year. And their liquidity on their PE side grew 50%. So the underlying metrics in a lot of these businesses are pretty healthy, and lower rates should be good for them. And I just think they're extremely well run by some of the smartest people in finance. And I like being partners with smart people in finance. So I still like that category a lot, and haven't sold any of my positions. The other one that I think is kind of an obvious bet, and I think a few folks are starting to pick up on this, is what are the industries where AI can be a meaningful margin contributor for the business? So I think it was C.H. Robinson that came out and talked about some of the efficiency they're getting with AI in terms of matching loads and drivers. Mm-hmm. But if we start to see, there's a chart I've put out a number of times showing the net profit margin of the S&P 500 since the internet. And really, it hadn't moved for 3 decades before that. And since the internet, it went up 7 points. Well, if we see that same thing happen with AI and we go up another 7 points in the next, 10, 15, 20 years, it's going to be hugely accretive to the S&P 500. Mm-hmm. And obviously, the companies that adopt early will see the biggest benefit. So I'm probably not the only one talking about this. I'm sure there's a bunch of smart hedge fund managers out there right now trying to poke through these industries and figure out where the most aggressive adoption is happening. But you're going to see it in retail. You're going to see it in healthcare. You're going to see it in transportation. There are going to be companies that are very aggressive on this front, and they are going to see meaningful impact. And you'll see it starting to show up in their margins. And that's where I'd be looking to bet.
All right, man. Well, listen, we covered a lot of ground. I really appreciate your insights. Like I started this conversation, your ability to kind of do a crossover is it's fascinating to me. I learn a lot about the private markets every time I talk to you. And one of my big takeaways, and again, I mentioned Jesse, I'd love to see like an IPO calendar that just heats up. You know what I mean? Just kind of, even like going to road shows and hearing these companies articulate. I know you go to a lot of tech conferences, and maybe these guys get 25 minutes and they're on a panel with somebody else, that sort of thing. But it would be really interesting to hear like a very targeted conversation geared towards investors and the investment community broadly.
I can't plus one that more. Because that's what we feel when we spend an hour with these founders. Mm-hmm. We were lucky to have Ali from Databricks speak at our LP Summit back in the fall. Mm-hmm. And I'm telling you, everybody in that room, and these are people that manage trillions of dollars of capital around the world, there's nobody that left that room and was not bullish on Databricks.
Yeah.
It's incredibly exciting. They're talking about all the things that are really happening at the ground level with customers, and really deep, meaningful metrics that reflect the growth of the business there. And then the new categories that they're investing in, and sort of talking about what those can look like and how big they are and how big the incumbent businesses are. I mean, just imagine that if there was a weekly or at least couple times a month roadshow with one of these types of companies, the excitement that would start to build as they shared charts and graphs and metrics and all the extrapolation that people could do, I think it would be transformational. And I think there would just be a very different level of excitement in the public technology investing universe. It was bewildering to me in the fall when people were saying, talking about OpenAI and Oracle and saying, we don't think demand is there for AI. And I'm like, well, that's because you're not seeing any of the data around demand. But just go look at that. People can search it up online. It's Ramp AI Index, sector adoption rate. And what they do is they measure adoption across all these different sectors of AI across tens of thousands, if not hundreds of thousands or millions of businesses. This is not just a tech thing. It's happening across all these sectors today and at a meaningful rate. When public investors start to see that showing up in the growth numbers of these companies that are hopefully going to go public, I just think you'll have a very different view on the longevity of this tailwind. But until we do, it's just folks in our world who get to see all the data and have these exciting meetings. But I mean, I can see it in your face. It is exciting, and imagine sitting at the round table in the afternoon at CNBC talking about one of these companies, and they come in and meet with you, and you leave and go, "Damn, that's impressive."
Well, it brings me back to the late 90s. I started at a hedge fund in 1997, and people probably listen to the pod have heard me say this. It was, SAC Capital, Steve Cohen, probably one of the most legendary, equity traders, let's call him a trader, but turned into this massive investment fund. And back then there was 30 people on that trading desk. And, I was the youngest guy on the desk. And, he kind of looked around, and the guy I worked for looked around and was like, listen, we want to know what YHOO, AOL, XCIT, LCOS, ATHM. I mean, I could go on and on. What do these companies do? Because they're moving around like crazy, that sort of thing. Yeah. And they were momentum traders, and they wanted to trade all this stuff. And so for me, it was a great opportunity, like a year and a half out of school, and I did not have a technical background. I was a political science major. You know what I mean? Like that sort of thing. It gave me the opportunity to really kind of learn what these companies did. I started going to the tech conferences, the brokerage-led tech conferences, and I was a dummy. I mean, I wasn't like a finance major or anything like that. And it was fun. I mean, it really was fun. And seeing like that entrepreneurial sort of, and I feel like there was a period maybe in the aughts where it was less fun. You know what I mean? And then it was definitely interesting a little bit with the crypto stuff.
It was not fun from 2000 to 2007.
Yeah.
In Silicon Valley. It was pretty boring until the sort of mobile era kicked off in 2008 with the iPhone and the App Store in 2010, and then things started to really heat up and it got exciting again. And cloud really, cloud everybody talks about starting in kind of the 2000s, but Salesforce was really the only software player in the cloud up until about 2010, and then you had a bunch of companies go public. But yeah, then it got really exciting for a decade, and then of course COVID hit, and it got unexciting in 22. And thank God for OpenAI and ChatGPT, and now we've got this whole industry that's just. I think that the thing that is hard, like, you were doing it back in 97, I was doing it in 95. And when you're in the middle of it, you don't spend as much time asking the question, hey, are we in a bubble? Mm-hmm. You just see the transformation that's happening on the ground and the products that these companies are building. And you go, okay, even if 80% of them don't work, what is going to come out of this is just going to be incredibly exciting. Mm-hmm. And in our world, we assume 80% of them aren't going to work. Yeah. Maybe it's 90. And I know that's really hard for the outside world and for public investors to think about, oh my God, I could be wrong 80% of the time. But the 5, 10, 15, 20% that become the Netflix, the Amazon, the Google, the Facebook, I mean, that's what we're all looking to back. And there are going to be some of those companies that come out of this era, I can 100% guarantee you.
Yeah, the hard thing is I just have so much PTSD from the post.com, and then you thought you were out of it, and then the financial crisis happens, and I think people forget from the highs in 2000. I mean, the NASDAQ took 14 years to get to those prior highs. Companies like, Microsoft saw their stocks just languish for a decade. You know what I mean? And it just felt like, the innovation was dead, the excitement in and around technology, in general. And I know it was folks like you who built in the software space and ultimately the SaaS space. And then
it was brutal.
Yeah.
It was brutal. It was hard to raise money. Everybody left Silicon Valley because they went into consulting and advertising and banking. It was a brutal, really kind of like 5 to 7 years.
Well, I'll leave it on this positive note. I mean, the one thing that if this bubble, and you say, well, maybe it's not a bubble, whatever the hell it is. Let's just say, we had some prolonged digestion period from a resource standpoint, not from a technology standpoint, okay? Just kind of misallocation of resources, It could take a while to come out of this, because there will be, compression on pricing, right? It will be one of those things where all that VC capital and, it kind of, subsidized what the end user is ultimately going to be,
The big difference though here is the bubble and Capex that people are worried about is not being funded by venture capital. It's being funded by earnings and cash flow.
But right now, but you did mention that in Meta and Oracle, it's starting to be funded by debt. And so that's something that we might see a Microsoft, do a similar sort of deal that Meta did. I mean, why wouldn't they? The terms look great. You know what I mean? So then you have this kind of off balance sheet situation. We'll get out of here, I promise. What my concern would be, and again, this goes back to my PTSD from .com and then financial crisis. This has the potential to be mashing those two things up together, because what's gone on here, despite what you say by the major hyperscalers who are funding it through cash flow, there is a financialization of all this that has not existed in periods past, and that we could probably debate that, but
the only thing I'll send you this report from Goldman Sachs they put out today. They touch on this topic, and they have a chart that says it's Exhibit 38. Corporate balance sheets have capacity to take on more debt. Mm-hmm. And what they show is basically the S&P 500 trailing 12-month net debt to EBITDA. And it's right now, it's at about 1.6x, which is the 45th percentile since 1980.
Right.
So we're not in back to my question of where's the bubble. There are these very unique scenarios with Oracle and all the circular financing that's happening with OpenAI. But broadly, it's not like the S&P is massively over-levered. Right?
Yeah, except that, okay, we're just going to keep going here. What you just mentioned was that $38 trillion debt that our government has. If you
worry about that.
Well, I know, but if you worry about that, then the next rung is going to be corporate debt, right? I mean, there's a potential for a crisis that starts with, debts and deficits and works its way around the world. I mean, what happened after the financial crisis here in the U.S., it was like a rolling crisis around Europe into, and that really was, it really killed growth in those areas for years.
We have benefited in the U.S. For, I don't know, a decade plus now of being the one-eyed man in the land of the blind. I mean, we are the place where capital wants to flow. You look at inflows of capital last year from all over the world. I think it was 500 or 600 billion. If we ever lose that status, then it's going to be challenging, right? If people aren't willing to pay up for our treasuries, if they aren't willing to pay up for our equities, I think a lot of people in the U.S. take for granted what a unique position we're in, right? There's 330 million people in the U.S. There's 7.3 billion around the world. So geographically, we are not a large part of the world, but financially, we are the epicenter of the world. And if we ever lose that, it would be really challenging.
Well, I think if you just reflect a little bit on what happened this weekend, if the U.S. becomes this really imperialistic sort of, whatever you want to call it, you do have the potential for wholesale selling of our treasuries. I mean, let's just be frank on that. And so, people say don't invest on geopolitical sort of situations. I mean, we might be, we might be at a crossroads that our country has not seen in over 100 years. You know what I mean? As far as our policy.
What's amazing to me, though, is if you wind back the clock, and you've been in this for as long as I have, you wind back the clock to things like 9/11 or the Iraq War, when that started, like the shakeup in the markets from those things was unbelievable. And you think about what we've been through in the last 5 years with Russia and Ukraine, with Hamas and Israel, with Venezuela, the market pretty resilient through all those things. And so you wonder how much volatility, what would it take to create a really extreme set of volatility in the market based on geopolitics?
There's an answer to that, Jeff. In the last 25 years, the way that the government has used its balance sheet and its monetary policy, basically think about each crisis as we got through each one of those. I mean, the dot-com thing ended in early 2003 when bombs started dropping on Baghdad, right? And we know that, like obviously it's sad, but wars are good for, the economy. And then into the financial crisis, we know what happens. The only year the stock market was down around the financial crisis here in the US was 2008. I mean, think about that, right? And it was unprecedented monetary policy. And then rates stayed low for a very long time. And then you saw the emergence of, this financial, we were attracting all that capital. Make no mistake about it, because what happened with that rolling financial crisis, it made us that much more attractive. China has its firewall. I'm sure there was some interesting things going there. One of the biggest IPOs of the last 20 years was Alibaba. Just think about that. But our investors didn't have access to there, so they come over here. COVID happens, you throw monetary and fiscal at it, and it ends up being a blip, at Silicon Valley. Blip.
Yeah,
you know what I mean?
I think, unfortunately, the biggest hangover from COVID is inflation from all the stimulus. I think that has proven, even though inflation's coming down, it has proven just...
Oh, the cumulative nature of it.
The cumulative price increase to take a family to dinner or childcare or buy a house is absolutely...
But by the way, a lot of people want to politicize this, Jeff. I mean, when you think about, what I'm saying is in late 2008, it was the Bush administration that, where they saw all that fiscal.
We did similar things then. Yeah.
No, and even in, 2020, the start of COVID. I mean, all that stuff started.
I don't politicize it, because
I'm not saying that you were. I think in this environment, though, because it just seems to be, we have CPI at 2.8%, you know what I mean? That's down from 9% in mid 2022, you know what I mean? But the cumulative nature of it, I think, is the most important point. And I go back to COVID in a way, and my view is that in my lifetime, we have never seen anything like that. I mean, and hopefully we never do again. So if you are this country and you're staring into the abyss, and you know how important, let's just say, your economy, your way of life is to the rest of those 8.3 billion people, you know what I mean?
Agree.
And, so like, for instance, if inflation was the aftermath of that, look at where the economy is right now. Look at where look where assets are. You know what I mean?
No, I agree. We did the right thing. I think I would argue that doing it 2 years later and funding things like solar, and that was not necessary. But no, I mean, people knock things like the PPP. I mean, first of all, like you said, we've never run anything. Like, my kids ask me, Dad, what was the last COVID pandemic like? I'm like, kids, I've been around for a long time. We've never had anything like this.
Yeah.
People literally thought the world was going to shut down.
Well, so to your point about affordability, though, and this is the thing, this is the aftermath. Like, every one of these crises, you have this widening, gap, right? And so, it's people who own assets and that sort of thing, and have college degrees.
And I will do a plug. This is where I think Brad Gerstner's Invest America will be the biggest game-changing policy of our lifetime.
All right, my man. Well, I appreciate it, and hopefully this is the first of many in 2026. Always appreciate your insights.
Man, let's do it in person in New York.
And when I'm in SF next too. Thanks, Jeff. Really appreciate it.
Awesome. Good to see you.
All right, man.